makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. China's second quarter growth disappoints amid poor retail sales and the latest sign of the nation's struggling recovery, prompting more stimulus calls. U.S. Treasury Secretary Janet Yellen calls for further de-escalation of tensions with Beijing, but says it's premature to discuss trade. Well, she joins us exclusively from the G20, plus Richemont shares slide after the Cartier owner reports an unexpected decline in sales from the Americas. Demand in Asia rebounds. So welcome to the program. Let's take a look at the European markets map. And here they are, a little bit of unchanged for the FTSE. You can see the DAX down 0.1%, the CAC 40. Bit of concern maybe about the luxury stocks because of those concerns about how much Richemont sold in the U.S. But the bigger picture, of course, is not only what's happening globally because of this earnings report. So we have many companies reporting in the next 2 to 3 weeks. I think our Bloomberg Economics went through the numbers and say that in terms of the percentage drop, they're expecting a 9% drop in terms of earnings per share in the U.S. The European stock market could be even lower, some 12% in terms of earnings per share. Now, the other big story is, of course, China's economy growing slower than expected in the second quarter, worrying signs of a slowdown in consumer spending, also ongoing pain, of course, in the property market, prompting a lot of traders expecting Beijing to do a bit more. And then the youth unemployment is what our Valley Titel decided to focus on because it's another record high of 21.3%. So, of course, if you have a balanced economy, this is one of the things that they really need to take care of. And then the dollar. Is this the end of an era? Now, we're seeing dollar weakness from quite some time. Dollar's busted bull run has strategists and investors saying that turning point is in hand. And of course, this has huge consequences, not only for financial markets, but global economies. And so, for example, some of the ripple effects that we've been looking at is reducing import pricing for developing nations, some of the popular strategies that have worked so far tied to a weaker yen, but also boosting U.S. exports at the expense of Europe. Those are some of the impact that we could see if the dollar slide continues towards the end of the year. So the yuan and Chinese stocks lower this morning after that data from China painting an image of uneven economic recovery. Now, the country's youth unemployment rate hit a record in June. GDP and retail sales came in below estimates, as we were just saying. Joining us from Hong Kong, Bloomberg's Jill Dices with the very latest. So, Jill, good morning. There's a call for stimulus. It's growing bigger and bigger, but will we actually get it?
I don't really know that we're going to get any kind of massive stimulus out of China right now. It seems like the government is really focused on this idea of very targeted types of support. There's been several economists who have floated the idea of maybe some new fiscal measures to try to help stir the economy. And ultimately, I mean, it might be something more similar to tax incentives or maybe an extension of additional sort of property-related targeted measures that we saw like last week when there was some loan relief extended for developers. That seems to be more of what's in the cards right now, because what this data showed us today was that the economy, while growing quite significantly year on year, that 6.3%, remember that compares to a very, very, very difficult 2022, when Shanghai was in lockdown, a lot of cities were sort of restricted. And so ultimately, while that number looks very nice, it's still less than what economists had expected. We did see that slowdown in retail sales growth, kind of hints to the consumption-driven recovery being faltering a little bit there. We've also seen that reflected in prior numbers on sort of weakness in household and business confidence. And then, as you mentioned, the youth unemployment rate just continuing to stick at those highs right now all indicates that the economy, while in trouble, maybe in need of some kind of stimulus. I think at this point, authorities are just a little bit too hesitant, or not. I mean, they're not too hesitant, but like they're just hesitant to do anything that would imply bringing on greater amounts of debt that they can't really afford. And so they're looking at targeted ways to try to continue to boost this confidence right now.
Jill, thank you so much. Jill Dices there with the very latest on the Chinese economy. Now, joining us now is Erik Nielsen, UniCredit Group Chief Economist. Erik, thank you, first of all, for joining us. We're keeping you for half an hour so we can discuss everything from China to the U.S. to what's happening in the U.K. How much worries do you have about China and the fact that we're expecting a lot more stimulus, but they're taking their sweet time?
I have worried about China for a long time. We both have these sort of big structural elements, the demographics and the handling of COVID and all these sort of things, and then we have the construction side. So we always thought they're going to slow down some, and I think these numbers they're not far off what people thought. And then we always have this idea that when China slows, they just sort of push the accelerator a little bit, and then everything goes again. This time they're a little bit more hesitant. I don't really know why. I don't know the policymakers there. But one thing is very clear: the way the Chinese accelerate or stimulate is through credits or other help for the big old industries, and that's not a good way of doing it. So I'm very worried about China's sort of longer term or medium term for growth.
But at the same time, I keep on being told that actually President Xi needs to remanage this economy to add more value. So if they can go up the value chain by around 30%, but that would mean less money to the old industries.
Absolutely. I mean, there's no doubt about what they should do, what they would like to do. I'm just not confident that they are willing politically to do what it takes.
Erik, our reporters on the ground also spoke with Janet Yellen, who's of course at the G20, and she spoke about US-China. Here she is.
The tariffs were put in place because we had concern with unfair trade practices on China's side, and our concerns with those practices remained. So perhaps over time this is an area where we could make progress, but I would say it's premature to use this as an area for de-escalation, at least at this time.
So, Erik, when you listen to that, and again, we're in an election cycle in the US, so how much more China bashing will we see, and does it translate into worse economics?
Yeah, I think it is, and I think there are two things here. The train has left the station in terms of free and low tariff trades between America and China, right? Then there is the present acceleration that we have seen because of all the noise around the two countries, and then, as you said, the election cycle in America. So you can't the next year and a half bet on America sort of giving China a sweet deal, right? And all this is bad for growth. Let's be very clear about it. It may be good for the long term of geopolitics or what have you. I mean, that's a kind of a different discussion. But as an economist, you look at what's happening now, it's not good for global trade. It's not good for global growth, period.
And we'll talk a bit more about supply chains moving and this de-risking. Erik Nielsen stays with us. He is, of course, from UniCredit. Coming up, Richemont shares slide this morning after investors focus in on declining revenue growth from the Americas. So we dig deeper into the numbers next. And this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Richemont shares lower this morning after reporting an unexpected decline in sales from the Americas. Now, it is raising concern over how weak the U.S. market might get. Follows fellow luxury brand Burberry, which also reported a drop in revenue in the region last week. Now, for more, we're joined by Deborah Aitkins from Bloomberg Intelligence. Deborah, thank you so much for joining us. So the U.S. decline, I mean, because this is ultra high luxury, it doesn't necessarily go to the fact that actually the U.S. consumer is spending less.
No, and so the number that's come in is -2% for the Americas, so we don't have an actual US number. And what needs to be taken into context is that that's against a very high 20s comparable base, but we still do see some softening. It's the one region where there's a negative number.
Yes, so is it because we were also expecting too much? Because it seems like, you know, they could actually price it to the hills, and how's Asia doing?
Yeah, and in terms of the US market in particular, we're looking at mid-single-digit growth, so we don't know what's under those numbers. Mid-single-digit by year-end, and there could be a fix because the comps become easier. And in terms of Asia, they've come in at +40, which is better than was expected. The market looked for 20. The market looked for 40, but is looking for 20 in Asia by end of year. So, and we've got a very easy comp coming through in their fiscal Q3. So I think one more than compensates the other.
Okay, really interesting, Deborah. Thank you so much. Deborah Aitken there from Bloomberg Intelligence. Now, still with us, Erik Nielsen, UniCredit's Group Chief Economist. And Erik, when you look at Richemont, look, there are signs that the luxury demand is weakening in the U.S. and possibly China, but luxury demand is not the normal consumer demand. So how's the U.S. doing?
I'm a bit worried. We have both in Europe but also in America, but America a little bit to a lesser extent, the following picture. we have very weak growth, but a strong labor market. That's usually not the combination we have. And the reason why we have weak growth is that the commodity price increases we had have eroded people's income. In Europe, a lot. In America, somewhat less, but still a good deal. So people are tightening up, right? So the question you have to ask yourself when you look at these products and any other sector and the economy as a whole, is the next step that somehow we start growing again from here, and we had a mini recession or near recession with no unemployment?
No.
Or do people start to lay off, the companies start to lay off people and we get a more traditional recession? I'm more in the latter camp, but it's a tough one. We have never really seen this before.
But how much of this is the overhang of COVID, or how much is it's just structurally our economies have changed? I mean, even if you look at how inflation's coming down, maybe quicker than we thought, it's all quite strange.
Yeah, so there is definitely a lot of COVID aftermath going on now. And I think personally that's what confuses the central bankers. You know, I'm in the camp who think that the ECB and maybe the Fed have overdone it, because you see these inflation numbers. Yeah. But what you see from COVID is that you're shifting back to the services now. So people you haven't traveled, you may have had your hair cut, but you haven't done your services or you've gone out. And now we are sort of plowing back, and there's a lot of overhang on that, but that's petering out. So we are going back to a more normal distribution of consumption between goods and services again. And that's disruptive, and it gives these strange inflation effects.
So do you think central banks should hold fire to see what happens next? You've always been on the camp that actually inflation was more transitory than central banks think.
Yeah, particularly in Europe. In America, there is, if I should round number, right? In America, it's probably 50-50 between demand and supply. In Europe, it's almost all supply. So the Fed has a better case of doing what they're doing. I would probably hold the fire here, but they'll probably do one more, right, or whatever. But it's like, but yeah, I think the risk is they overdo it.
Erik, what's your take on when you look at the dollar weakness? If this continues, I mean, this changes everything. It changes economies, it changes investments, it changes markets.
Yeah, I mean, look, it's first of all, we are not outside sort of historical ranges, right? So it's just that people always thought, oh, well, like the dollar has to be strong, and particularly when you go through a very tense geopolitical situation. We have the war in Russia and Ukraine. We have the China relations. So naturally, we went through a period where the dollar was strong. Now things eases a little bit. It sort of feels like you had Janet Yellen in Beijing after they didn't want to talk to each other for a long time. So this eases. So I think this is sort of the underlying story. That's good for Europe particularly, because our energy gets cheaper, and so it's actually not a bad thing. But and I don't think it's going to get too worse, but I think it will still get a bit weaker.
Erik, thank you so much. Erik Nielsen from UniCredit stays with us, and we'll talk about the UK next. We look at the outlook for the UK as a new survey says business confidence remains strong and well above the European average. That's coming up shortly, and this is Bloomberg. So UK business confidence remains strong and well above the European average, according to a survey of 12,000 businesses by Accenture and S&P Global. The net balance of firms expecting activity to increase over the next 12 months stood at plus 40% in June compared to plus 19% across continental Europe. Now, this comes as a separate survey of economists paints a more gloomy picture, projecting that Britain's economic growth will fall further behind the euro area next year. Well, here to discuss all of this, Barton, Accenture's strategy lead for Europe, and still with us, Erik Nielsen, UniCredit's Group Chief Economist. So thank you both for either joining us or staying with us. Rachel, what can you tell us about the survey? So I find a lot of these surveys quite confusing, because periodically, every 6 weeks, there's also surveys in saying, look, inflation is higher than many countries around the world. Interest rates are higher than many countries around the world. And so consumers and companies are worried.
So, as you said, Francine, and thank you very much for having me on the show today. In this latest report, UK companies are signalling robust levels of confidence. You gave some stats there about where we fall versus our European and global counterparts. And in this era of high inflation, many firms are under pressure. So the question for executives is how to transform and reinvent despite some of these macro challenges. And of course, this survey looks at a forward outlook. So I would feel encouraged that British firms are already taking action. We saw companies turn to growth, strong investments in artificial intelligence. They've almost doubled in the last year. And also for the first time since early 22, we're seeing an uptick in firms' intention to invest in research and development, as well as capital expenditure and employment.
So, Rachel, very quickly, when you look at the survey, do you know why they're optimistic? Are they optimistic because the job market is holding up and they're ready to spend? Or are they actually optimistic about the world economy?
Well, UK business has shown itself to be highly resilient in recent years, very adaptable despite some of these macroeconomic challenges. And although we've seen tremendous highs and lows across the world, the UK has consistently exhibited around twice the confidence levels of the rest of Europe. When I talk with business leaders, I'm seeing them refresh their strategies, really looking at technology as a way of creating bolder ambitions for the future. In private equity, we're seeing huge investments in artificial intelligence, generative AI, in order to be much more targeted on assets for value. Consumer goods, we're seeing big investments in resilient supply chains. So I think that adaptability that we've observed from the UK is really where we are seeing those green shoots of confidence come from.
So, Erik, what's your take on the UK economy? If you look at, we have the latest survey also of economists by Bloomberg saying that GDP will probably grow some 0.6% in 2024. Your area, it should grow by 1%.
Yeah, I'm still worried about the UK. I mean, I haven't seen the survey. I haven't seen the survey we talked about, but you can certainly. There are a lot of great businesses in the UK. One thing that strikes me is that if you look at the PMIs, both for UK and Europe, there's a very big division between those in the service sector and those in manufacturing. And services are more optimistic than manufacturing. And maybe this reflects a little bit the fact that in the UK we have a little bit more service companies which invest, as she said, in technology and these things. So, but the UK is facing massive problems. The Brexit is not done yet. We have a fundamental issue. This is sort of my key concern about the UK that we don't talk enough about. It seems to me that the UK population wants, broadly speaking, the same services, public services, as the rest of Europe in terms of defense and healthcare and pension, all these other things. Yet,
how do you fund it?
How do you fund it? And so far, over the last 10, 20 years, the UK taxes the economy by 7, 8, 9 percentage points of GDP less than Germany and France, Netherlands, and even more than Italy. So how do you square the circle? Right? Yeah. There is absolutely, Martin Wolf at the FT had a great piece last week, I think. There is no way that you can square the circle without putting taxes up a lot. And so much so that I wonder politically how you do it, right?
But Erik, is there also something in terms of population growth, or that there's the labor market is just odd because they don't have enough people. So no matter how much of a recession almost, it's going to be fully employed. Yes,
that's exactly right. So this comes back to what we talked about before, where we have a fundamentally strange situation with weak growth and a tight labor market. Yeah. But all of Europe, and including the UK and maybe particularly the UK, has this problem that we don't like immigration anymore. The one reason why the UK could square my circle about tax revenues versus demand for so many years was they imported all these doctors and nurses from abroad, and the real income in these sectors declined and declined and declined. Now we don't want them anymore. So how in the world do we do it? Continental Europe suffer the same type of problems of demographics, if to a little bit lesser extent, but it is the sort of medium, longer term, a massive issue that Europe has to figure out how we deal with.
And Rachel, if you have a breakdown, is manufacturing, doing better than some of the under industries? Like, what's the breakdown of who is feeling more confident out there?
Sure. So if we look at manufacturing and services, we saw a slight decline in the services confidence. In fact, manufacturing in the UK fell by about 10 points. It's still more confident than manufacturing colleagues across Europe, but we absolutely saw the challenge, particularly in chemicals, timber, metals, around high costs. Maybe companies are still getting through the stockpiles that they accumulated during COVID. And to the point around wages, absolutely saw that the 3/4, in fact, of UK companies surveyed did think that wage wages would need to go up, largely due to the cost of living crisis and the labour shortages that were just referred to then.
Rachel, thank you so much. Rachel Barton, there, Accenture's strategy lead for Europe, and Erik Nielsen, UniCredit's Group Chief Economist. Coming up after JP Morgan and Citi's results on Friday, we'll look ahead to more big bank earnings this week. We'll discuss what to watch out for next. And this is Bloomberg. Now, China's second quarter growth disappoints amid poor retail sales and the latest sign of the nation's struggling recovery, prompting more stimulus calls. U.S. Treasury Secretary Janet Yellen calls for further de-escalation of tensions with Beijing, but says it's premature to discuss trade. She joins us exclusively later from the G20. Plus, Richemont shares slide after the Cartier owner reports an unexpected decline in sales from the Americas, but demand in Asia rebounds. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So Wells Fargo earned more net interest income than analysts expected in the second quarter. The San Francisco-based bank has also lifted its guidance for the full year as big U.S. banks continue to benefit from rising U.S. interest rates. The CFO, Michael Santomassimo, spoke to Bloomberg on the back of the results.
We're relatively small, compared to some of the, the big peers out there. But it's something that we've been focusing on now for the last few years, and just really making sure that we're consistently adding the right people. We're investing in technology, and really the focus is to just support our clients better. It's focused on the U.S.-based clients for the most part. There's some outside the U.S., but really primarily here in the U.S., and it's just supporting our corporate clients and our asset management clients and others just better and better each day incrementally. And so we're happy with the performance we had this quarter and last quarter, and I think that shows through the fees. But it's something that we'll just keep gradually building on over time.
Mike, let's talk about commercial real estate, because it caught a lot of eyes that actually Wells Fargo increased the allowance for credit losses by about $950 million. And it was commercial real estate office loans that were cited for the reason behind the move. So as I understand it, you haven't seen significant losses yet, but you had CEO Charlie Scharf say that you expect to see it play out in the market over time. When are you anticipating to see peak pain for commercial real estate?
Well, I think I would just broaden it a little bit first, and I'll come back to office. And when you look at the overall credit picture, it's quite good. On the consumer side, we're seeing a little bit higher charge-offs, but that's off historic lows. And so, that's actually performing quite well so far. And broadly on the commercial side of the business, it's going quite well in terms of both the our middle market and commercial banking clients, and big chunks of the commercial real estate portfolio are actually performing really well so far, particularly given where we are in the cycle. And so really this conversation is focused and isolated on the office portfolio. And I think as you look at office, it's a lot of the trends that we all are talking about now for a while in terms of return to office. Companies needing less real estate, and that's starting to come through in different cities and different properties across the country. And what we did today, or in the quarter, is make sure as we sort of look at all the things that we can see and then think about a whole bunch of different scenarios that we stress in the portfolio, and so we built a reserve that we think is appropriate to deal with a number of those scenarios. But keep in mind, we haven't, as you said, we haven't really seen the losses be significant so far. But there will be some weakness over time, and it will play out over an extended period of time, and likely years, not months or quarters, as people work through the changing patterns and different issues with individual properties.
Wells Fargo CFO there speaking to Bloomberg's Romain Bostic and Katie Greifeld there. Now, JP Morgan revenues soared to a record $41.3 billion in the second quarter, boosted by high rates on its takeover of First Republic Bank. Quarterly net interest income rose to an all-time high, with the bank also hiking its full-year NII forecast to $87 billion. Now, the Chief Executive Officer, Jamie Dimon, says the U.S. economy continues to be resilient, but he did caution on the outlook and recessionary risks.
The headwinds are substantial and somewhat unprecedented. This war in Ukraine, oil, gas, quantitative tightening, unprecedented fiscal needs of governments, QT, which we've never experienced before. And I just think people should take a deep breath in that. And we don't know what those things are going to put us in a soft landing, a mild recession, or a hard recession. And obviously, we should all hope for the best.
So here with more, Bloomberg's Leonard Kenscherper. So Leonard, now that the dust has settled, how good were these JP Morgan results?
Yes, I think you could already see from the reaction of the shares on Friday that they didn't react too heavily. So a lot of expectations might have been baked in already. And as Jamie Dimon said, there are some unprecedented headwinds, and it's not just potential pain from consumers, not just potential credit card delinquencies. It's also the Fed's quantitative tightening, which will, in the coming quarters, drive up banks' funding costs. So I think it's fair to say that bank profits won't keep on surging from here.
Any red flags?
Yes, I think one area of concern is commercial real estate, especially for old offices. And another big cloud that generally hangs over US banks at the moment are the potential higher capital requirements that the Fed is expected to impose at some point. Jamie Dimon, I think, also said basically hedge funds, private credit, they're dancing in the street right now because they're expected to gain more market share from lenders here. And it also shows you how worried lenders are. They're losing market share to non-banks here.
Leo, when you look at, of course, some of the other bank earnings, it's a huge week. What are you looking for? Not every bank is created equal in the U.S.
That's true. So I think Goldman Sachs is the most interesting one to report. They're due to report on Wednesday, and they've been quite proactive in flagging how bad trading went in the past weeks. So they said investment banking slowed down, trading momentum slowed down 25%. They flagged write-offs in their real estate book. And they did all this because their shares dropped in the past 2 quarters on earnings day. So they really want to avoid disappointing investors again on earnings day. And we'll see how that plays out on Wednesday.
All right, Leo, thank you so much for joining us. Of course, Leonard Kenscherper there on the very latest on some of these banks. Now, Nordea Bank also reporting better than expected profits in the second quarter, supported by tailwinds from rising interest rates. Now, the biggest lender in the Nordic region raised its full-year profitability guidance as net interest income rose 40%. So joining us now for more on this is Bloomberg's Chris Jungstedt in Stockholm. Chris, good morning. So what are the main takeaways from Nordea this morning?
Good morning. Well, Nordea posted better than expected figures overall. What can be said is that their return on equity guidance for the full year had been criticized by analysts prior to the report. However, their boost of that guidance to comfortably better than 15% has not been that well received by the market so far, with shares just slightly up today. Net interest income, however, was 40%.
Yeah, sorry, go ahead. Net interest income 40%.
Yeah, net interest income was 40% higher than last year, and that was in line with expectations. Analysts do, however, expect this to be the peak in terms of NII growth.
So other Nordic lenders reporting this week, will they all be similar in terms of what they're reporting or what you're looking out for?
Well, the NII is, of course, always important, and perhaps even more so in this new climate. After the Riksbank's rapid rate hikes, it's a new ball game for private consumers, for corporate customers, and for the banks themselves. Mortgage margins are highly under pressure, and customers are shifting deposits to more expensive savings accounts. So analysts expect NII to drop going forward. So any signals or hints in that respect will be highly interesting, of course.
So what are the impacts of commercial real estate turbulence on the Nordic banks?
Yeah, that's a big thing this week, of course, and this story will go on for a good while. There seems to be different views on it, however, though. Moody's recently cut the outlook for Handelsbanken's credit rating to negative, citing concerns for these exposures to the commercial real estate sector. The Swedish FSA head, however, recently, just the other day, said that the worry about these exposures is perhaps a bigger thing among foreign investors than among Swedish investors, and added that he is not concerned. What can be said is that investors seem to be more critical. All the Nordic banks, except for Danske Bank, have been lagging European peers so far this year, and that is in part because of these worries.
All right, Chris, thanks so much. Chris Jungstedt there in Stockholm for us. Now, also a trio of French businessmen led by telecoms billionaire Xavier Niel have pulled out of the race for the troubled retailer Casino. The withdrawal by the investors after months of work leaves the way clear for Czech investor Daniel Kretinsky to take control of the French supermarket group, which has been struggling with debt for several years. Coming up, the G20 meeting for finance ministers and central bankers has kicked off today. Key themes, of course, inflation, energy, and EM debt. We're live in India with all of the latest. That's next, and this is Bloomberg.
Our expectation is that the headline inflation will decline slowly, not with the speed of headline inflation. Core inflation will be slower. So this is, I think, because of the fact that headline inflation is influenced by energy prices, and the core inflation is influenced by the increased prices, wages, services. So a mixed situation, but overall, I think we will have in 2024 the level of inflation near to our targets.
So inflation has peaked, underlying inflation has peaked for Europe.
For sure.
Is stagflation the right word to use to describe the European economy right now?
Well, listen, we still have growth. Weak growth, of course, slightly weaker than expected in the first quarter and probably also in the second quarter. But if we look to the last autumn, we were expecting a real recession, blackouts, energy problems, supply problems for energy. These risks didn't materialize. I'm not saying that we don't have any risks ahead of us, because indeed tightening of monetary policy will produce impact, and also the energy transition. We are not completely out of the woods in Europe. We made a miracle in going out of the dependency from Russian fossil fuels, but it will be a challenge also for next winter. Overall, I would say we are not in a stagflation situation. We still have growth, and we expect in 2024 to have stronger growth, and we have an incredibly resilient labor market.
Well, that was the EU Commissioner for the Economy, Paolo Gentiloni, is speaking to our Haslinda Amin from the G20 meeting of finance ministers and central bank governors in India about the outlook for inflation in the euro area. So let's talk more about the G20 meeting, where some key items on the agenda include inflation, debt relief, and sustainable finance. For more on all of this, we're joined by Bloomberg's Manaka Doshi. Manaka, good afternoon to you. What's actually coming out of the meetings today?
Well, three key issues under focus here, Francine. The first is the reform of multilateral development institutions or banks, how they can raise or enhance their finance capacity, especially through private capital. The second, more relief for debt-burdened low-income countries, and whether the Zambia debt resolution is a precedent-setting one for many other countries that are waiting in line for the same kind of solution. And third, whether this meeting is going to end in a communique with a resolution on the use of the word war, or is this also going to be a chairman's summary of sorts? And these three are the key talking points here in the conference in Gandhinagar.
So, Manaka, we're also hearing of a renewed focus on India and economic growth there.
Well, that's right. I think, Francine, as you know, our G20 meetings are, of course, multilateral conversations, but also an opportunity to do bilateral talking. Here we've had the Indian finance minister, who's playing host to this meeting, speak with finance ministers from across the world to talk about the India story, friendshoring, China +1. And that's a conversation she had with the Indonesian finance minister as well, who spoke to Bloomberg, underscoring the relationship between the two countries and how India India is now providing an alternate route to China.
China is not recovering as what we originally thought after opening from the COVID. So Indonesia is now looking at other alternatives like India. Here, we are here, is actually growing in terms of the market.
And that's exactly what U.S. Treasury Secretary Janet Yellen also emphasized earlier in the morning here today after her bilateral conversation with the Indian finance minister. She underscored the relationship with India, emphasizing the close friendship and also talking about how India represents a great friend-shoring opportunity. Don't forget, this is Janet Yellen's third trip in a year here to India.
Thank you so much, Bloomberg's Manaka Doshi there in India for us at the G20. Now, coming up a little bit later, this is an interview you don't want to miss. We'll be speaking to the U.S. Treasury Secretary, Janet Yellen. Catch that exclusive interview right here on Bloomberg TV. It's at 1:10 p.m. UK time. Coming up, the dollar. Bloomberg spot index was down some 2% last week, the most since November. We'll discuss the outlook for the world's most important currency next. This is Bloomberg. The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, we're just getting some breaking news out of Morgan Stanley. They're updating their GDP forecast. Now, Morgan Stanley cutting its 2023 China GDP forecast to 5%. Earlier, they were expecting a 5.7% increase, and it's a similar move from Citigroup. So they're now expecting China 2023 GDP to be 5% instead of the 5.5% that they were earlier expecting. Now on to the dollar, seeing its worst slump since November last week as traders see the Fed's historic rate hike cycle cooling or stopping soon. The world's primary reserve currency is now teetering at the lowest level in more than a year. Now for more, let's go straight to our Bloomberg MLife currency and rate strategist. He's Ven Ram. Ven, always good to have you on TV. So thank you so much for coming on. The bears are out for the dollar. What's your take?
Morning, Francine. Thank you for the kind words. Well, there are broadly two ways the U.S. economy could evolve from here. One is that inflation slows to an extent that the Fed becomes convinced that it will meet its inflation target and they back off from further hikes. Or it could be that the labor market completely crumbles. In either scenario, the dollar will continue to weaken and the euro will go to $1.14, the pound to 135. Those are pretty much consistent, Francine, you will remember, with levels that MLife forecast at the start of the year. If we stay in a world where inflation isn't the 8% we saw last year, but still middling in the 3 to 4% range, the Fed will not cut rates. But even in that scenario, the dollar will tread water. So pretty much it is a dollar bearish scenario. There's no question about it.
But Ven, what does this mean? I mean, this changes everything, right? It changes traders, it changes markets, it changes deficits. Like, is there a critical lever for where, you know, some countries could be in trouble if dollar goes below that?
Well, I think on the DXY, if the dollar goes below 95, we could hear a lot of chorus from other central banks, and we would see this competitive devaluation starting. But at the moment, because pretty much all the non-dollar currencies were battered last year, they're not quite back to levels where, say, the ECB would start pushing back on strength in the euro, where the BOE would start pushing back on the strength in the pound. We are not at those levels yet. But as you say, if the dollar index weakens to 95, we could be there.
Ven, what's your take on China right now? So I don't know whether you play it through renminbi if we do have more concerns about the economy, unemployment, especially for the youth at a record high, with policymakers not doing as much as markets are expecting them to.
Absolutely. I think the most direct way to play it is through the offshore yuan. Now, there are several points that jump out from the disturbing Chinese data that we got this morning. One was that growth in the second quarter was supposed to have topped 7%, given that Shanghai was in lockdown at this point, the second quarter last year. So while 6.3 may look pretty impressive prima facie, it really isn't. And we got a dichotomy between factory output that did pretty well, but retail sales were nowhere near as good. So it shows that the Chinese consumer is not willing to really spend. So where is China going to find that growth? It's going to find its growth from relying on its age-old model, which is reliant on exports. And in order to rev up exports have been in a funk too this year. And in order to rev up exports, you need a much weaker yuan. If you look at the yuan this year, it hasn't weakened that much at all, 3% or thereabouts. And China needs a much weaker yuan to get to that 5% growth rate this year.
Yeah. So, Van, overall, I mean, given all of this context, I don't know whether, rates are juicier than currencies. Do you look at treasuries maybe, or is the dollar really the dominant one?
I would definitely be inclined to look at long duration treasuries. I just wrote last week that, look, I mean, if you're in the hunt for duration, now is the time to be doing it, because the US economic cycle is aging and there are visible cracks in the economic momentum. So I do think that, now is the time to lock in the duration trade. Now is the time to be buying the 10-year treasuries. Now is the time to be going in deep on 30-year treasuries, because you're unlikely to get those yields for too much longer from here.
Van, thank you so much, as always, for joining us. Van Ramther, Bloomberg MLive currency and rates strategist. Now let's take a look at what we're watching out for the rest of the week. Today, G20 finance ministers and central bank governors meet in India to discuss economic trends, energy security and support for developing countries. Tomorrow, more U.S. banks report earnings, including Morgan Stanley, BNY Mellon and Bank of America. Then on Wednesday, UK CPI data comes out. It's expected to further demonstrate the persistence of UK inflation. On Thursday, we'll get the latest interest rate decision from the Turkish central bank, which is predicted to continue its aggressive monetary tightening campaign. We'll also be keeping an eye on U.S. initial jobless claims data. And finally, on Friday, Japanese CPI data due to be released. It's expected to confirm that inflation in the country has reached its peak. Well, that's it for the Pulse. Up next, Bloomberg Surveillance Early Edition. They'll go through most of the market moves. This is Bloomberg.